Hi, everybody. Welcome to the 7 and 7 show with Zach Ellison. Today we have with us Jane Leung, who most recently was CIO at SVB Private Bank and also head of investment solutions. And obviously, with everything that's gone on with Silicon Valley Bank and SVB, this is a great time to be talking to Jane. She's no longer there. And Jane, we'd love to hear about your background, how you got here, what you're doing at SVB, and some of your views on the markets.
Great. Thanks, Zach. Thanks for having me. I'd be happy to share a little bit today. But about me, I was born in Canada, but moved to California when I was very young. And after kind of a brief stay in Malaysia, where my dad was a professor of physics at the University of Malaysia. And I basically started off my career dabbling in investment banking and then a few years in a boutique RIA in Los Angeles. But then I spent the bulk of my career really in institutional asset management at both Barclays Global Investors and then also in BlackRock. And I spent, 7 years as an expatriate in Hong Kong, landing in 2008, just before the global financial crisis. And, that was really an interesting time. We saw, really crazy market movements and volatility and risk, which we'll probably talk about today. And I came back to the U.S. in 2015 and then really spent the rest of that time, focusing on private markets at Scenic Advisement, which was a boutique investment bank in San Francisco, and then eventually to SVB, as you mentioned, where I joined as the chief investment officer, and then eventually also the head of the Modern Family Office, as well as the head of investment solutions. And so I was also leading their investment services division, which was our private client broker-dealer platform. And we were building that out really to differentiate ourselves within the innovation economy, which is, technology founders and investors, such as PE and VC. And I'm currently based in Los Angeles, have a husband, son, and 2 cats. And that's a little bit about me.
It's great that you're here because the timing's really perfect, given that everybody wants to know, what happened with SVB, but more importantly, where do we go from here? And one of the things that's great about what you were doing there is that you are not on the commercial banking side, which ultimately is what caused the demise of the enterprise, but you are on the private banking side, working with high net worth clients and basically running the wealth management unit. So talk a little bit about what happened, just so people understand the different parts of SVB, and then we can get into what you were doing there specifically.
Yeah, no, that's right, Zach. I mentioned, I was the chief investment officer when I joined SVB Private, which is the private banking, wealth advisory, and sort of trust division of the SVB Financial Group, which was the umbrella group, and SVB. The commercial bank was the sort of the 40-year commercial bank that had been, around servicing the innovation economy, and which unfortunately, it collapsed in a few months ago. And so, that was also differentiated from the SVB Capital division, which was our venture arm and fund management division, as well as SVB Securities, which was the investment bank. And so, there were a lot of different divisions, and it was very good to be a part of, that organization. So clearly, we had a niche in terms of servicing the innovation economy, and I think we had a great opportunity to be able to build wealth and help, our clients with their needs. And so, we were building, family office services. We were building out quite a lot there. And I think it's unfortunately what happened, but we look on to the future. And I think, it's a great opportunity to talk about that now.
So digging into positive things, what do you think about as the core investment principles that you live by that have served you well over the last couple decades that you've been successful in the business?
Yeah, these are great questions. And I think about them often, particularly in these days. But one of the key investment sort of mantras that I have is really, know what you own. This is really, really critical from a risk management perspective. I think there are too many people who just assume they know what they own in their portfolios, and they assume they know what the risk is in their portfolios, but they often don't. And I think when you don't know what you own in your portfolio, you run the risk of going into really bad situations where you get unexpected and unanticipated outcomes. And the sort of the second core investment sort of thing that I think about a lot is really, and tell people that they need to do, is to really ask questions. I think that, people, again, don't really ask enough questions, and they don't dig too much beyond the surface of what they are doing in their investment portfolio or what their advisors are doing. And I think if you don't do these two things well, you're never really going to have success within your investment portfolio, and in working with an advisor as well, too.
I think your point about knowing what you own really resonates. And the way I think about it is really understanding at a deep level the risks and the opportunities in your portfolio, especially the risks. And if you think about the best investors of all time, you think of names like Warren Buffett or Peter Lynch. And one of the things that they all have in common is that they invest in things they know. They don't chase the hot new thing just because somebody said it was great on social media. And, quite frankly, I think we need a back to basics approach to investing. I mean, some of the stuff I see now in the market just boggles my mind in terms of what people are investing in. It's like, it's crazy. They're not really investing, they're speculating. That's becoming mainstream and accepted for some reason. But I'm curious what you think about, modern investing, what we've seen in the last couple of years in this bull market.
Well, I do think that what we've seen in the bull market is that in some ways people have just been able to kind of have their portfolios rise with the tide, and it almost didn't matter what you were doing. You could almost, throw a dart, throw a spaghetti at the window or the wall, and wherever it stuck, it would be fine, and you'd have a great performance. And I think that what happens, and what has happened in recent years, is that the market conditions have changed, and a lot of investors and advisors that are out there haven't really seen difficult cycles, and difficult markets. And so I think that leads to an issue because, again, when you don't know what you own, and you're in a great market environment, your portfolio is going to do well no matter what. But when you're actually in a more challenging market environment, it actually matters what you have. And it matters not just what allocation you have, like what percentage of stocks, bonds, alternatives, et cetera. It also matters like what's underneath those allocations, and kind of going deeper into the weeds around, what specific investments are you in? And, take the example of private markets and public markets. I think that, as we all know, there has been kind of a shift over the years into more alternatives and more private market investments. But I think that the bulk of the clients out there, the bulk of managers and advisors out there haven't really evolved in terms of understanding how that risk plays out in their portfolio. And so, they may have had, a liquid position or an alternative investment that was a relatively small portion of their portfolio. And so they were able to really kind of assign that risk kind of just generically and say, okay, that's risky, so I'm going to kind of just do a barbell approach and have fewer, risky assets or T-bills or something on the other side. I mean, that may be a little bit of a kind of a simplistic way to say it, but in the reality is that then they haven't really understood the risk of what they've owned. And they also, may end up with an outcome in their portfolio that they weren't expecting. So again, I think, as we see a trend moving into different asset classes and the need to understand more complex portfolio constructions, kind of using the old methods of measuring risk and understanding what you own are not going to cut it.
I 100% agree. And I think most people have no idea about the risks that are in their portfolio, because to your point, everybody's only seen up and to the right in terms of performance over the last 13 years. And even now, when we're projecting and predicting that there's going to be a recession, potentially a deep recession, the markets are still strong. I mean, the market's still up this year, mainly led by a couple outperforming large cap tech stocks around, the AI boom, essentially. But, I think we need to go back, like I said before, go back to basics and say, okay, in a down market, how is your portfolio going to perform? And do you actually have a sense for how it's going to perform? Or have you just invested blindly into a bunch of different assets that you don't really understand because they were going up and for the last 13 years? in many ways, I think we've got a generation of investors that are just going to be completely clueless because they just have never experienced a downturn. The last real downturn we had was the GFC. And so if you weren't managing risk at that point, like, I don't really care what you have to say. Like, not to discredit people that weren't that weren't around then, that are smart and doing things now, but the reality is everybody made money the last 13 years. So I could care less what your 13-year track record is. Show me your track record from 2008 to 2010. And if you lost money, explain why. And if you didn't lose money, now I want to invest with you. That's kind of how I think about it. And I think we're definitely seeing people start to awaken a little bit, but I think it's going to take a real recession and a big downturn in asset pricing before people start prioritizing risk management first again.
Oh, absolutely. And I mean, I think people are already starting to realize that that old 60-40 mix is not really working. I mean, I'm sure most of us have read about how it's just not performing as it was. And I mean, think about it. We are not in the same world as we were when the 60-40 kind of made sense. And that was actually when the 60-40 was actually a mix that could give you some element of diversification, which is critical, right, in any kind of portfolio construction sense. But the reality is that 60-40 is very correlated now, right? I mean, the correlations between stocks and bonds are higher than they've ever been, and certainly that's why investors are need to think about how to get into less correlated and assets and more diversified portfolios. But how do they do that? And particularly when they're still kind of like, well, I've been doing this for a while. It seems to make sense, but it's not just that allocation, as I mentioned before. The traditional assets that that make up that 60% of the equity, large cap equities or whatever it was, may not be the place to be. Maybe you need to find income from public real estate or infrastructure or, high yield bond investments or venture debt or alternative. I mean, there's all kinds of things. I mean, there are no shortage of investment solutions and products out there. But I think the challenge for investors is to figure out which ones to put in their portfolio, either on their own or with an advisor. And then do they have the tools, or does the advisor have the tools to understand what that portfolio mix and what those risks really are?
So taking a half step back, I really love your point about correlation in a quote, diversified 60-40 portfolio, because the reality is stocks and bonds are highly correlated. We saw that in 2022. I don't think that's going to change near term. And the reality is you can't claim that you're putting your client in a diversified portfolio if it's only got stocks and bonds, because that's only a small segment of the market. The majority of the market's actually private alternative assets. And so by definition, when someone says, yeah, I'm in a diversified portfolio because my advisor has me in 60-40 with, diversified stocks and bonds, I'm just kind of like snickering, because you have no idea what you're talking about. Your advisor doesn't either, because that's not a diversified portfolio, and it's not going to withstand a recession because they're going to go down together, right? And so that's a key point you made. And the other thing I wanted to touch on briefly is there's been debate recently, and there always is, around passive investing versus active investing. So passive would be investing into an index, like an ETF. And active management would be giving your money to somebody who's running a strategy and making day-to-day decisions on how to allocate. And a lot of folks have said passive is king, active management is dead. But that's because they're looking at the last 13 years when it was a bull market. And in a bull market where there's just a up and to the right trend, you want to be paying as little as possible for beta exposure. In other words, you want to be invested broadly across the market, and you don't want to be paying for it. So you want to be in the S&P 500. You want to be in bond indices. Well, not with rates where they were, but generally speaking, you want to be broadly diversified, and you want to pay very little for it. But in a down market, that's when skill matters. And that's when you want to have active managers running your money and not just throwing it at an index. Because average performance is great when the market's up 30%. You do not want average performance when the market's down 40%. And that's what I've been trying to explain to people that say hey, I'm good with ETFs. I'm like, yeah, you were good, but you should be thinking on a forward-looking basis, and you're not going to be good. And you're going to be coming back to me crying when you're down 40% because you've got a lot of beta exposure and you're not making active management decisions. So,
Well, and like, look back. I mean, I having come from the index world and spent most of my career, managing index funds and launching ETF businesses, I can absolutely attest to the need to have not just one, but both styles, both active and passive, and really to be able to, toggle through them depending on the market environment and also depending on what exposure you are trying to get. And again, this is why you need, as an investor, to dig deeper and to go beneath the surface than just, for example, the 60/40. I mean, you need to understand that, okay, maybe for certain environments, as you mentioned, bull markets, or in certain exposures, like perhaps, US large cap, if you want to be on that, that side of the fence, you'll want to be kind of in an index exposure. But on the other hand, if you're trying to look for a precision exposure, now you could get that through an index. You could use a high yield bond ETF, but you may also want to look for the manager, like an active manager who can actually and has the experience managing in challenging market environments to find those hidden gems and that performance and that alpha, which in challenging markets is harder to do, but absolutely the way that you will be able to enhance your returns. And so I think the reality is it's not either or in terms of index or active. It's really, how do you blend them, and how do you understand what you own and create the exposure and the portfolio that you need to achieve the goals?
100% agree. I think people sometimes misunderstand my philosophy around investing. I think you need to be in a core portfolio of index, essentially, where you've got large cap stocks, you've got broad exposure, and you've got cheap exposure, essentially. I actually don't think, though, that people should be in corporate bonds, and I've thought that for years, and you can see why. I think you're getting the risk without the returns, right? So it's return-free risk is always kind of like the joke, but it's not funny when your bond portfolio is down 25% like it was last year in treasuries and corporates, right? So it's return-free risk is not something I want in my portfolio, but I do think you should have a core, and then you have a satellite approach around that, where you've got targeted exposure that gives you diversification, gives you other things you may need, like income, for instance. A lot of people value, so looking at private credit or real estate that can produce income, but with lower correlation to the market and higher risk adjusted returns, it makes a lot of sense. So I want to get back to some of the key questions, and we've already kind of touched upon some of these, but in terms of risks that you're thinking about for the industry in general and for investors in general, what keeps you up at night, and what are people missing?
Yeah, I mean, there's a lot of things that keep me up these days. I mean, we do live in, crazy times. If I've learned anything over the last, 3 years, it's to, expect the unexpected. And, I think that, again, some of the risks that we are facing and what keeps, me up at night, and particularly what I worry about from a wealth management industry perspective and clients, is that, again, and I think I mentioned it before, people don't really question enough, and they don't really, kind of understand the true risks of, what they're holding. And I think, it's really, really important to be able to focus on risk management, because these are really different times. And I think people need to really understand that. But I also think that the risk of being afraid of this environment is that some people are also kind of worried about when and where they get back into the markets, and in which markets and in which exposures. And it's a little bit of a paralysis, because for some, this is really uncharted territory. And so, what keeps me up at night is that people aren't asking enough questions about what they already own. And secondly, that they aren't really thinking about the long term and really thinking about how they just do need to actually start to invest in the markets, and how they need to figure out where are those, uncorrelated and diversified sources of return, how do I find them? How do I get in that portfolio? Because no one's getting any younger. And if the key for most people, I think, is A, to build enough wealth for themselves to be able to live off of and to create a comfortable lifestyle for them and their immediate family. But also for many people out there in the world, it's to create, some kind of generational wealth and a legacy to leave for their families and their sort of the broader, society in some cases. And how do you build that? And how do you build that in these kind of crazy times? So I think, having that kind of challenge ahead is kind of daunting, but I think it's an interesting opportunity. It's an interesting opportunity for the wealth management industry to be able to think differently about how they're doing things and really break away from the traditional mold of, here's how we've been doing wealth management, so we'll just continue doing it the way we've been doing it because it always works until it doesn't, which is these times, and I think going forward. So I think thinking about a new approach and how to approach and build wealth is going to be, a really interesting opportunity for the industry. And certainly as an investor, it's a great challenge, right? Because there's so much out there, and being able to figure out how to build that portfolio to withstand these types of times is a really interesting challenge and opportunity.
So speaking of wealth management, what are the big themes that you're seeing there? Technology and AI being one of them. There was an announcement not too long ago about JP Morgan looking to roll out an AI advisor, essentially, and everybody's going to follow suit. I mean, it's going to be prevalent. What does that mean? And what does the theme of consolidation mean in the RIA segment? We're seeing all these RIAs getting rolled up, buying each other. So those themes and other themes, what are most relevant for you thematically?
Well, look, I mean, I think that thematically, there is no doubt that there is huge amount of consolidation going on in the industry, because I think everybody knows that wealth management is and has been a really growing part of the world, and we need to really get on top of that, particularly for smaller wealth advisors who are trying to differentiate themselves and really kind of do something different. But really all that's out there is the traditional way of doing wealth management, which, from a client perspective, I don't think serves them. But also, with everything that's going on with technology advancements and with all the competition out there, advisors are going to be needing to do something different. But, consolidation aside, if all you do is focus on that consolidation so that you can kind of gain more market share, the question to me would be, who's actually at the shop minding the assets and being the advisor that the client hired you for? And I think, we were talking about that before. It's a very interesting thing to consider, because the consolidation is going to continue, because people need to figure out how to build scale, because this is a scale business in as much as it is also a relationship business. But it's also, an advisory, and it's a fiduciary business, and you have to know what you're doing in order to be successful. So I think the other theme of, technology that you mentioned is definitely a way for, firms to be able to accelerate, to be able to really scale, and to be able to provide the best insights. And I mean, I think one of the things that I would recommend for people either who are managing their own assets or for advisors is to really get the best technology, get those tools that you can, get the best tools that you can and that are out there. And I will tell you, I've watched that space grow significantly over the last decade in terms of the ways you can use technology to manage risk, to really understand what you own in your portfolio. And to the points we talked about before about what keeps, me up at night is, when you use this tool, when you use these tools, when you use these technologies, it can help you to have better insights. If you're an advisor for your clients, or if you're the actual investor, it can help you understand the risk better in your portfolio. And you're going to need to do this given where the market is heading in terms of the types of investments that you're going to need within your portfolio, whether they're alternatives or illiquid securities and other things that may not have easily been modeled, or analyzed previously technology is going to help us. But the reality too is that at least at this point, and we'll see what happens in the future, the technology, the computers aren't running themselves. And I say that lightly because I know where it's all heading. But right now, you still need to have the ability to make sense of all the data and everything that the technology brings to you. And so being able to take those data points and then turn them into real actionable pieces to your portfolio and strategies for your portfolio, that's really the key of the execution of a strategy that's going to withstand the challenging market environments and to get you the types of returns and performance that you want, either as an investor or if you're an advisor for your clients.
So we've touched upon this. In addition to technology and consolidation, the other big theme is the move into alts, right? Everybody who's smart money is moving into alternatives, and that's like an unequivocal, factual statement.
For a long time, right? But it's more around now, how the sort of the more kind of less, the non-institutional investor is now moving.
Right? So to that point, Jane, what are the benefits of alts for high net worth non-institutional investors, just from a portfolio perspective?
I mean, the biggest thing, it's the obvious thing. It's not even the performance. It's really the diversification. And it goes to the comments we made before about, when you're constructing a portfolio, and this goes for anyone at any kind of, wealth level, you need diversification in order to weather the storm in terms of the different types of market conditions that are out there. And before, a long time ago, a 60-40 allocation of stocks and bonds was kind of guaranteed to give you some level of diversification, but that's not the case anymore. Now that there are higher correlations across stocks and bonds, we've had to move over. I mean, institutions have been doing it for many years already, but everyone's going to have to move over to less correlated investments in order to have diversification, which you need in any kind of portfolio sense. So for the average investor, retail investor out there, you need to find a way that matches your risk tolerance, but that allows you to have proper diversification. And that's why having some component to alternatives, and again, it depends on, what your income and risk tolerance, levels are as to what those alternatives look like. But you need to have something different than just the kind of traditional 60-40 split.
So in terms of alts, what are the alts that you like best? And also, given your experience at SVB and venture debt and your deep understanding of that, I'd love to hear your thoughts on why venture debt makes sense for investors in this part of the cycle.
Sure. Well, I mean, look, SVB, I think had about, was one of the largest, if not the largest lender of venture debt. I think it had around 60% of the market at some point. And, certainly from a founder point of view, venture debt is a really attractive alternative, and not alternative. I'm sorry, that should really stress it's not alternative, but complement to venture capital and equity. And that's, really because there's less dilution, it's cheaper, there's just it's quicker to get. Then that's just from the founder side. But from the investor side, I mean, there are clear advantages because there are higher yields associated with venture debt. But the best thing about it, and you kind of alluded to it before, Zach, was that on a risk-adjusted basis, I mean, it's actually lower risk as well, too. So you basically lower your portfolio risk using, venture debt without sort of compromising your overall returns. And then you also achieve that diversification, which we talked about with this, which is truly, truly important. And again, because venture debt is kind of largely uncorrelated and not precisely correlated with a lot of the other types of investments that most people have in your portfolio, in their portfolios, it really is an interesting investment. And I think, look, it hasn't been as sort of publicized or as popular as I think it probably should have been, but it's getting there, right? And particularly in this kind of the last few years where, the equity and fundraising window and private markets kind of halted and really the IPO window closed. I mean, there was not a lot of appetite for founders to raise capital, equity capital, at the risk of, having to create a valuation that would create a down round, a lowered valuation. But also in this time of the pandemic, there is a need for cash, right? And so venture debt from a founder perspective creates that runway that allows a bridge, a little bit more time to be able to, continue their business. And again, this is for, already successful businesses who've had venture, capital and equity raised. And so these aren't just fly by night companies. These are actually some of the best sort of startups and technology, as you know, Zach, very well. And so I've always felt that venture debt would and will, be kind of coming into its own, so to speak, in the coming months and years because of the risk characteristics and the return, profile that it brings. And I think that this could really apply to not just institutional investors, but also, to non-institutional investors of certain sizes and sort of risk tolerance, obviously.
A question I always get is why isn't venture debt more well-known or more popular with institutional investors? And a big part of that is that it's a very small segment of the market. And especially, 5 or 10 years ago, it was too small for institutions really to care. So even though some of them may have recognized the great returns and the low risk, it just wasn't big enough to make an impact in their portfolio. But one thing we have seen is a trend from some of the smartest, largest asset managers in trying to get into the space. Oaktree, for instance, is an investor in the space. Blackstone is now investing some of their own capital in the space. And just recently, BlackRock, your former employer, bought one of the biggest venture lenders in Europe outright. And if you read the press release and read between the lines, it's because they want to provide differentiated access and a diversified option for folks that want to be in a high income, low risk product. And so finally, I think we're getting that stamp of approval from the big time managers that are basically validating it. So whenever I see an acquisition like that, like BlackRock's acquisition, it makes me smile, right? Because it just means that, hey, now all the people that were too scared to get in or didn't really know that they should be looking at this basically have to. Because now if you're an advisor and you don't have something to say about venture debt, you don't have an excuse. And, it's funny because I talk to a lot of investment consultants that advise pensions, endowments, and other institutions. And, they would say, yeah, we looked at venture debt a couple of years ago, and they literally had not looked at venture debt in the last 3 to 5 years, despite the fact that it's booming, and, it's, growing almost exponentially, and it's had an incredible risk-adjusted performance, but they haven't looked at it. But now they have to, because if they walk into a client and the client says, hey, tell me about venture debt. What are your views on SVB? How does that create an immense opportunity in the market? Because the demand for capital is still there, but the supply is now diminished. So you've got great economic opportunities for lenders in the space right now. And if you don't know how to talk about that and you're not educated on that opportunity, why are you in that room? And I think people are going to start to realize that, and they're going to start to hold their advisors accountable, both institutional consultants, but also wealth advisors. You've got to have a view. You can't have the excuse of, hey, we haven't looked at that because we're so smart making money in crypto, or, you can't do that. And so that's, something that makes me happy. It basically just brings, visibility to this product that I've been talking about for a couple of years now, and nobody was listening. Now they're all listening.
Just keep going, because look, what's not to love? You got a lot. For those who aren't aware, the loans, they tend to be short term. They're floating rate, which is great in this environment. That's another thing that I think has made everything, more attractive from that perspective, given the rising interest rate environment. So again, what, to your point, you've got to look at it, as an advisor or as an investor in a portfolio, because especially you have to be looking for different sources, of uncorrelated and returns that are going to be diversifying in your portfolio. And, venture debt is one of those, I guess, asset classes, we want to call it, that is really going to kind of make a difference, in my opinion. And certainly there are, a number of other things too to be looking within, liquid alts, private equity, private credit, real estate. These are the different types of alternatives that, investors and advisors are starting to look into. And again, institutions have been looking, at these and investing there for decades. And even if you look at some of the endowment funds, the current allocations to alternative sectors and asset classes are really, really high now. I think Yale is probably at the highest and maybe a little bit of an outlier. But I mean, you got to sometimes follow the smart money, right? Or at least be aware of what they're doing, even. And, it may or may not make sense in your portfolio, but it behooves you as an investor and advisor to understand, where the smart money is.
It's funny. So I send some of these folks that I'm friends with what I call CYA notes. Yeah, CYA notes. And it's basically, hey, here's what's going on. You don't need to invest, but now when somebody asks you, you're the smartest person in the room and not the stupidest, right? Because there's that whole joke about poker players. Like, if you're not the fish at the table, if you don't know who the fish at the table is, it's you, right?
Yeah.
Like, if you don't know who the dummy is in the room, it's you. That's how. So you got to figure that out pretty quick. So we're just about out of time because we went longer than usual because you've got so many good things to say. I wanted to just mention one last thought on investing in innovation and venture capital and venture debt, which is, to me, innovation is the asset class, because innovation is what's creating value at every level of the economy. Small, big, it doesn't matter. It's all about innovation. And so the question for investors is, how do you want to access innovation? And the reason I've always loved venture debt and the reason that I transitioned my career to do this is because I feel like this is the best way to access innovation as an investor, because you're getting the income, you're getting the diversification, but most importantly, you're getting the safety. And so you don't have to worry about, to the same degree as equity investors would, a downturn in the economy, because this is not a binary outcome. You're getting your 15 to 18% all in debt coupon, plus you're getting equity warrants on the deal, so you participate in the upside. So that's kind of how I think about it. It's really investing in innovation in a safer structure. And that's just how I think about it. I think that's how folks that understand the product think about it for the most part. With that, I wanted to just get your parting thoughts on any key themes over the next couple of years. So we touched on some of them. But anything you want to leave the audience with in terms of what they should definitely be thinking about as we head into more uncertainty?
Well, I think that the main thing I would say is just to keep a level head through all of this, particularly as I talk to, clients and certainly, investors who have not been through downturns such as this, is that it will pass. These are cycles. And I think if there's, I don't know if it's a theme, but it is a comment around, how to navigate through the challenging times. And it's really just to know that, these are cycles. Use the best information, get as much information as you can, have the best tools that you can, have the best advice that you can. And then just realize that, everything is going to be okay in the end. And there's somebody said, if it isn't okay, it's not the end. So you just keep going, and really, follow, your head and ask those questions. And I think, innovation will continue to be, I don't even know if I've called a theme, because I just think that it is ingrained in where we are for the future. We're not going to be able to be successful if there aren't innovations in technology, innovations in wealth management, innovations in, how we approach things, innovations in our own thinking. And so, again, I would just say, ask those questions and keep, iterating on what the right solutions are for you, your portfolios, or however this can be applied. So that's all.
Jane, I love talking to you. I'm excited to see where you go next. You've got tons of great firms that are, hot on your trail, basically looking to hire you. And I know you've got a lot of options, but I'm very excited for when you determine which one you want to go to. In the meantime, is there any way for people to reach out to you? Is LinkedIn the best way, or are there other ways?
Oh, LinkedIn is great. I'm very active on LinkedIn, and I'm checking it. So I'd love to hear from anyone who's listening, and it's always great to make a connection. So thanks, Zach, so much for having me. It's been really fun.
Yeah, thank you so much for coming on, and thanks everybody for listening to the 7 and 7 show, and we'll see you soon. Take care.